Hi, friends. This is Colin Richards, president and founder of Lord & Richards, and welcome back for this episode of the Lord & Richards Show. And each week, we talk to you about principles pertaining to a successful retirement. We warn you of things that might be a danger to your retirement, and we also help you with strategies that can help you flourish in retirement. We call this process a retirement freedom review. It's about enjoying your life, seeking fulfillment and joy. What we do is we help remove the obstacles to your financial success in multiple areas. So there is an indicator we get from the world's greatest investor named Warren Buffett. I've studied his life extensively. I've studied his investment philosophy. I'm not going to say I'm in his brain, but I've gathered as much intelligence as I can. Somebody has said you can borrow brains, you just can't borrow character, right? And so in borrowing the brains of Warren Buffett, he says there's a key indicator that tells us if there's a potential for the market being overvalued. In other words, the stock prices are too high. It measures the U.S. total market cap across the gross domestic product. So it compares the value of the stock market against our gross domestic product of our nation. And right now, we have a market capitalization that is surpassing 230% of our gross domestic product, our whole economy. So our market is being told that it's valued more than our whole economy by more than double, by 230%. This indicates a significant disconnect between stock prices and the actual economy. So I've got to point out that there's a possibility that markets will eventually realize this, and those who purchase stocks in large volume will begin to adjust accordingly, driving those prices back down to where they ought to be. You say, well, what are the prices right now? Well, if I take the whole S&P 500, one major index, okay, that tracks 500 great companies, growth companies here in the United States, Standard & Poor's tracks them passively. It has what's called a price to earnings ratio. Okay, so if you value a stock at a certain value and then add up all of the outstanding shares and then compare that to the actual earnings of the company, what are we valuing this company at relative to its earnings? Well, historically, we've seen numbers more like 16, 17, 18 when the market sits at what would be called maybe a fair, even-handed value. Right now, we're just shy of 23 to 1. So every dollar of earnings is being multiplied by 23 times across all of the S&P 500 companies. Another way to look at this is you would say, okay, if I were buying an S&P 500 company, what multiple of their earnings might I be willing to pay? And typically that sits between 16 to 20. Today, companies are being valued very much higher. And so then the question is, as a bargain hunter, when you go to the store, do you look for sales? Do you look for opportunities? Are you trying to buy high, okay, or are you trying to buy low? Generally, the advice is buy low and then sell when it's higher, or hold through those periods and just enjoy the growth trajectory of the company. But right now, if you are buying stocks, you are paying a high price for those, okay? There's not a lot of value there. There's another ratio called the price to sales ratio. And broad market models that are evaluating total U.S. stock prices versus prior year sales say that the market is strongly overvalued. So what should we do about this? Should we just get rid of our portfolio? No, because market timing is a real challenge, right? This has to do with, okay, where am I going to invest new money? Does it mean you should abandon the companies you're invested in? Well, at Lord & Richards, we take a long-term view. We want you to develop a long-term view. Again, quoting from Warren Buffett, he was asked, how long is your average stock holding period? How long do you own a company? And he said, forever. As a matter of fact, he's famous for this quote: if you can't own a stock for 10 years, you shouldn't even try to own it for 10 minutes. What is he saying? Well, an investor invests in companies. And so I'm not talking about dumping all your stocks. What a wise investor does, though, and I referred to this in our previous segment, is we barbell against that risk. So should we put all of our money in the stock market where at any moment it could return to previous valuations and we just lose a major portion of our retirement savings because of the reduction in value? I would suggest we should not. I would suggest there are other pools of money that we should be looking at. And we're going to get into that in our next segment. What are the alternative strategies we can put on the other side of our barbell that will offset the risk, or at least some of it, in our stock market focused portfolio? And no, I'm not talking about bonds. I'm going to suggest that bonds are not a good alternative to stocks. They can move together downward with stocks. What I'm talking about are alternative investments that will protect you during down markets. And that's a critical piece of the pie that most pre-retirees and retirees are missing, and it must be addressed, folks, if you're going to diminish the likelihood of failure in retirement. And I would hate to tell you of the number of conversations I've had with people who failed to get this right. We want to help you. We want to help you get aligned. It's a process we call a retirement freedom review. And we're in a mini-series on the subject of managing risk. This is a key component. Unfortunately, many folks go into their retirement years continuing to invest just like they did during their working years. I want to tell you this is a severe mistake, and we will actually help you test your portfolio to see if it's aligned with the concept of retiring versus the concept of accumulation, with the concept of distributing your income over a lifetime versus the concept of being able to hold on to and never take anything out. They're two different problems. And as retirement specialists at Colin Richards, one of our key areas of specialty is managing risk. And the biblical principle we base that on is found in Proverbs 13:11. Wealth gained hastily will dwindle, but whoever gathers little by little will increase it. In our previous segment, we talked about the dangers of the current overvalued market. And no, we did not suggest you go out and dump all your stocks, but we did suggest that bonds are not a sufficient hedge against the downside risks of the market. There are other hedges, there are other ways for you to protect yourself. And like the wisest investors of all time, such as Warren Buffett and others, there are strategies we call the barbell, whereby you place your risk on one side of your barbell, but you place the money you're going to live on the other, and develop strong protected strategies that counterbalance the risk. The wisest investors do not bet the farm, folks, but many of you are doing that, and you're thinking that you're safe because you've got a 60-40 stock bond mix. That's 100% not true. You cannot diversify away market risk. You say, wait a minute, I've heard that my whole life. Well, guess what? That is actually a test question for every investment advisor who becomes a fiduciary. But yet we turn around and we say that to people and we reassure them based on false ideas around risk management. I'm here to give you the truth of what will actually work in your portfolio. And if you don't get this information, you could be in dire straits. So in the last segment, we realized, wow, price to earnings ratio is high. The Buffett Indicator that compares the value of the market to our whole economy says that the market's valued more than 2 times the whole economy. How can that be? Sales are not justifying these valuations. It's really just the motion and energy of buyers. And that's just like any market. And so if you're buying into the market now, you're buying high. So what can we do? Well, let me first give you the simple advice from Warren Buffett. He gave investors 2 rules. Rule number 1, never lose money. Rule number 2, rule number 1. I think that's great advice. And here it is from one of his chairman's letters. So if you can get access to the philosophy of the world's greatest investor, Warren Buffett, listen to what he had to say in this particular letter. He said, the line separating investment and speculation, which is never bright and clear, right? It's not easy to tell. It becomes blurred still further when most market participants have recently enjoyed triumphs, like we have here in the recent years. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one big party. Isn't that true? People just don't know how to hedge their risks, and they want to stay full forward. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. You see, the clocks of the market have no hands. We don't know when the other shoe will drop. We will not know when midnight strikes and we're dealing with pumpkins and mice instead of a horse and carriage to take us away from the ball. So here's what we need to do. Instead of being like Cinderella at that ball, waiting too long, staying too long at the ball, let's develop a strategy, a forward-thinking strategy that addresses the fact that the stock market is overvalued. I'm not going to suggest you remove yourself from that market because it's very difficult to time it. But what I am suggesting to you is that we have a conversation around risk. You know what we do? My clients sit down and they share with me using some simple charts. They show me. They actually show me the amount of risk they can tolerate and yet still remain invested and still be able to emotionally enjoy the experience of being retired. And they might share with me, oh, Colin, I would not want to lose more than 20% of my $1 million or $2 million or $10 million or $20 million portfolio. Wherever you are, the same principles apply. Or they might say very conservatively, I don't see myself losing more than 10 or 15%. We write that down. We call that your safety percentage. And Lord and Richards, with our expertise and specialty in risk management, will actually design for you a portfolio that, when tested, does not penetrate your downside safety percentage. That is peace of mind. I was speaking to a client last night, and she shared that. She says, I just have so much peace after working with you and your team. It really has made a difference in my enjoyment of retirement. And that's what it's all about, folks. We don't need to be on vacation with family, suddenly realizing that the clock has struck midnight and our stocks are still forward and we've had no hedge against loss, and all of a sudden our beautiful carriage has turned into a pumpkin. Our wonderful horses, our mighty steeds are now mice. Folks, that's not the way to go. The time for action is now, before the clock strikes midnight. Did you know that you can prepare in advance for market declines? I'm going to take you way back, but some of you remember 2008, 2009. Do you know that not one of my clients lost a dime of their money during that time because they were prepared in advance for it? I'm not saying that I'm all-knowing or prescient. I'm just saying there are strategies available today where you can put a floor under your feet, eliminating downside risk on a portion of your portfolio while still participating in the upside of the market. It's one of the greatest innovations of our modern times, and it strikes me as odd that everybody isn't shouting it from the roof, because had we known this in 2000, in 2008, in 2011, 2015, 2022, had we known it right before COVID, we would not have had to sweat the catastrophes and the down markets that surrounded those years. Folks, it begins with a discussion about you, your goals and values, and then we come alongside as an expert, as a specialist in managing risk and helping you to enjoy your retirement. For us and for you, it simply starts with a phone call.